So when we dispose of a non-current asset, whether sell it or trade it in, there was a lot of steps to remember in this chapter. So what we might do is try and summarize them by comparing the two procedures and then looking at what they have in common, because that'll help us save some time. So whether it was a sale of a non-current asset where we got cash, or we traded it in where we got credit off a new asset, step one was always transfer the historical cost of the asset. That's the same for both procedures. So is step two, transfer the accumulated depreciation. So no matter what the case study or question that we've been given is, the first two steps will be the same, whether it's a sale or a trade-in. Step three is where we had a difference. So for the sale of a non-current asset, we recorded the proceeds of the sale. All that meant was we recorded the cash that we got. Whereas step three, we're not getting cash. What we're getting is called a trade-in allowance. And we're getting that because we're actually going to buy a new asset once we've disposed of the old one. Step four, though, was identical. Whether it's a sale or a trade-in, we record whether we made either a profit or a loss. And for a sale of a non-current asset, that was it. We were done. What was different with the trade-in was we had one extra step, which was we're trading the old asset in for a new one. So we better record the purchase of a new asset in the sundry creditor account. So rather than trying to remember 9 steps, try and make it a little bit easier by remembering what they have in common. So steps 1 and 2, always the same, and step 4 is always the same. That way you can really narrow your revision into step 3 and step 5. That way it'll make it a little bit easier when we're processing these transactions.